Hey, Dustin Tibbits here, financial advisor with Jazz Wealth Managers. If you want to check us out, jazzwealth.com. And if you think that I need to shave, wait till you see Eric. Have you guys seen Eric in a while? Huh? No? Yeah. Like it's out there. Big beard. We're going to do a whole thing on it. Hey, anyways, let's talk about the stock market here. There's a lot going on. All right, so we're going to go over here. We're in September. This is the Dow. Let's go to the S&P. Sitting at new highs. This would be if we close up here, this would be the 28th new high of the year. Just nonstop, right? Slow, steady uptrend if you're kind of following along on how things are going there. And it's kind of like a warning sign, right? Look, you got now almost 90% of all days this year have closed inside of what we would call overbought or extremely overbought. So all I did is just took a chart here and just color coded it to show you the different deviations away from the moving average. And so look, the blue line is the S&P. It's overbought, it's overbought, it's overbought, it's overbought, it's overbought. And now we're extremely overbought here in the short term. Now that doesn't mean that we would have a pullback. We know from our historical stats here, let me show you that, the stock market does like to sell off through the later part of the month. And certainly that's possible. We don't really have any data to go on, though. There's not a lot there. We had the Fed announcement. We've got another couple weeks until earnings. We don't have a whole lot in terms of what we call economic data that moves the market. So I don't know. What we end up with is a market that's sitting here extremely overbought, which makes it really difficult to get aggressive. I want to share one other thing with you. The market being overbought is one thing, right? The markets can be overbought for extended periods of time. It's not anything that's odd. What's really odd is if we look at the participation. So on the screen here, I'm just showing, today, right, in the last 5 days, we're looking at each individual sector in the S&P. So there's 11 sectors. Well, if you look inside of it today, tech is the only thing really participating. Utilities don't move the market. It's a very small piece of the market, the S&P anyways. So not really much to go on. Tech is literally lifting the market. So that's it. That's the only thing that's holding us up here. Look through the list. Industrials, energy, healthcare, consumer staples, consumer services, consumer discretionary, blah, 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 blah. Financials down 0.6% on the day. And so we have this really, really low participation rate. Another way to look at it, I put an extra little slide. This might be a little, let's just show this. We have less and less stocks trading above their 50-day moving average. Now, this is not magic or crystal ball sort of thing. We just need a benchmark. So all I'm doing is saying, show me the percentage of stocks that are above their 50-day and show me if that rate of change is growing or declining. You could use anything else that you want. It's just a quick way to see, are most stocks doing this or are they doing this? So we look at the dark blue line there. Dark blue shows the percentage of stocks over the 50-day moving average. See how that's trending lower? We have less participation. We got more stocks moving lower than higher. And in fact, if you look through today, well over 50% of the stocks in the market are going down versus up, but the market is up. Well, that takes you back to technology. Technology is such a huge part of the S&P. We don't need much participation from anywhere else to get the market to move higher. Now, more of a mid to longer term look is when you use the 200-day moving average. That's the red line in this case. So the majority of stocks are not moving above their 200, or they're trending back down towards their 200-day. So you got this, market moving up, some would say on thin air, right? Hot air or whatever you want to call it. A lot of participation from tech, but really nothing else is lifting the market. If tech takes a break, you already have the rest of the market showing weakness. So be cautious there with your September excitement. One thing that I do want to point out, if you have a 401k, not so much the TSP, but if you have a 401k, 403b, whatever, and you have a small cap growth fund, small cap index fund, or small cap blended fund, something like that, you might notice that that's helping your 401k performance. And that's just because the Russell 2000 as a whole hit new record highs. And this started last week because of the rate cuts. Why is that? You know what small caps are? It's just a short shortened version of the word saying small capitalization, market capitalization. It just means these companies are smaller. If we add up all their shares times the share price, the value is not $1 trillion like some of the bigger names. It might be, and this is not small, but it might be $50 billion, right? Just a much smaller company. Well, smaller companies have a greater response to interest rates being lower or higher. And that's because they don't have the same, financial wherewithal or abilities that Apple might have. So something like Ollie's Bargain Outlet, right? They can't borrow money like Apple can. It's not as available to them, probably not at the same rates, and it's not as liquid as Apple could just literally go out and sell bonds if they want to. So they respond a little bit faster. Well, we have this projected lower interest rate environment, then the actual lower interest rate environment. And those small cap stocks did finally hit a new high. They were the last to actually get anything done there. And so I just thought that was interesting. One last thing I want to share with you here is, we're going to use a big word, correlation, right? Is one thing correlated to the other? And what we're going to look at is the individual stocks in the S&P. How correlated are they to the movement in the S&P? So is it one for one, right? Like if Nvidia goes up $1, does the SPY go up $1? No, that's not the case. If Home Depot goes up $1 or a 1%, I should say, does the S&P go up 1%? Is it that correlated? Or is there like a 50% correlation? 1% equals 0.5%, something like that. Well, the reason I want to share this with you is because there's almost no correlation on a 3-month basis of the individual stocks in the S&P to the performance of the S&P. It's not there. That's just another way to see that the market's moving higher because the really big names that have 10, 15, 20% of that market cap or the index weighted market cap, okay, well, they're lifting the markets. Look at Tesla the other day after that good news. Okay, fine. Apple a little bit, right? The big names, your Nvidia and things like that. Okay, they are helping move the market, but the average stock is only correlated by essentially 10% of what the market does. In other words, this is like putting Jello on a plate. There's no telling which way it's going to go. One piece goes this way, one piece goes that way, right? That's what's happening in the market. Well, it's not historically a bad thing. However, running into extremely overbought scenarios with very low participation, and I would argue just slightly below average volume, okay, that doesn't bode well for really strong performance, in the short term. Now, Newton's physics law, right? An object in motion tends to stay in motion unless some equal or opposite force gets pushed upon it. Well, an object in motion, the S&P is in motion. There's really nothing to push us against it. It's not like a shocking, oh my God, I couldn't have expected that to happen. We have no scheduled real news, like we mentioned. We have the thick of earnings season. It's 2 weeks away, right? We have Costco, Micron, CarMax. Those will be some earnings that we see this week, but not much, right? So an object in motion may just stay extremely overbought in motion. However, you gotta see those warning signs of, whoa, we're not all participating here. This is a little bit shaky at these highs. Anyways, that's our belief there. In our funds, we're actually taking a little profit off the table there. If you don't know, we manage our own expense-free funds here. We build them ourselves. And so for our clients, we're investing for them. Instead of just buying a mutual fund and hoping for the best, we actually will go and build the funds for you. Well, we don't feel that there's a need to be 100% invested. And we get to say that because in our aggressive mix, we're actually outperforming the market. So we're not behind, we're ahead of schedule. Really cool. And so when you see things like that, that's why I share this with you. When you see things like that, well, you got to do something about it, right? All right. Hey, have a great rest of your day. Thanks so much for watching. Appreciate the trust and hopefully the lessons that you learned here. If you'll hit the subscribe button or just give us a thumbs up, that works for me as well. All right. Adios.